I couldn't be more excited to welcome Brian Singerman of Founders Fund as part of our final week, the LP week of our Affore's Angel to Fund Manager program. I got that all out in one sentence. The reason Brian is so exciting to speak to is because if there is an epic VC, it's him. He's in some amazing companies, in an amazing fund, and there's so much we can learn from him. I'll begin with a standard question, like how did you get into venture? Looks like you were an engineer at Google, had an amazing time there, must have had an amazing time there from 2004 to 2008, and then Founders Fund was your first job outside of Google. Looks like. Can you just walk us through your sort of starting point as a venture capitalist?
Sure. Hi, everybody. Yeah, I was at Google doing engineering and engineering management. But I had a huge interest in angel investing. And so after a Google IPO in late 04, I started doing just personal angel investing in kind of 05, 06. And this was when, back in the early days when there were like just a few, right? You're talking to Anne soon. Her partner, Mike, is one of my mentors from dating from way back, right? And so I was doing personal angel investing and then I liked it a lot. So I actually tried to start Google Ventures, but this is in like 05, 06, and they had no interest in doing Google Ventures at the time. And then, so I raised my own fund of my own money and a bunch of Google people's money who wanted to do investing but had no idea. And this was basically at that time to invest in Y Combinator companies. And this is when maybe there'd be like 10 people at Y Combinator demo day. It's wasn't anything like it is right now. And so invested that. Loved doing it. Actually left Google because wanted to make it my full-time thing and was going to just raise a small fund. And that's when I met up with the Founders Fund guys. And at that time, so I became friends with Sean Parker. And at that time, they were considering an investment in a ridiculous company called SpaceX. And I said, this is what I want to do. And so I joined Founders Fund in 08 instead of raising my own fund.
Wow. So you were of the same generation or same group of folks as Mike and Josh Koppelman and folks like who were starting out on their own. Well, those
guys predate me. Like the only ones who were doing this at the time that I was doing this, or before I was doing the main ones were like Ron Conway. And so I made a deal with Conway, like, hey, I'm a Google engineer. I want to see all your deal flow. I'll help you diligence, companies. So it's like Conway and Maples, obviously. Clavier, who you've had on before, was in the game there. Obviously, Koppelman in first round, but it wasn't huge back then. It was only a few names.
Was this? It's part of you must have felt I could do this on my own. I could start my own franchise. What was it that kind of moved you from going from angel investing to becoming part of Founders Fund? Why not go it alone back then?
The companies that I wanted to do, like SpaceX, didn't need wasn't going to make use of a 500K check, right? So I don't like restrictions on what we invest in, right? And kind of if you're just doing a small angel fund, it's kind of like you've got a specific set of companies that you can kind of invest in. But I wanted to be able to write, 100K checks, or at that time, SpaceX was by far our largest check ever. It was like our first check into SpaceX was 20 million out of a $200 million fund. And I like being able to write 100K to $500 million checks.
Wow. That's a great spectrum. Like it must be liberating to be able to do what you want if check size is not a constraint. And that sounds like that was a draw. That was a reason for being part of Founders Fund.
Yeah, I wouldn't have joined any other firm. I mean, most firms have kind of rules on what they invest in. This Founders Fund at that time was Wild West. Right. We had no rules, just invest in awesome founders and invest in awesome companies and make a bunch of money. There was no like, oh, we have to do it like this or like that. It was Wild West, which fits my style. And it was a tiny team.
What was that process like as you were speaking to the various partners at Founders Fund to get a sense of whether you'd gel with them, whether you'd vibe with them, when did it click for you that this is the right group?
I mean, pretty immediately. I mean, I became friends with Sean, and then, it's kind of just definitely my style of not having, again, rules and being the Wild West, and no other fund is really like that. And I mean, it was definitely a personality fit with the rest of the team, whereas I don't think it would have been anywhere else.
What was those early days like? Did you have Founders Fund is famous for not having formal partner meetings. Like, what other rules was sort of traditional in venture even now or back then, but which sort of Founders Fund kind of upended? The process of running a fund or diligencing a company or investing. Like, what were some of the things that were different at the time?
I mean, tons. We've never had a thing such as an investment memo. We've never had a thing such as a partner meeting, right? Like I was way more likely to be out at 1 a.m., on a Tuesday getting a drink with the founder than we were to be doing a pitch meeting on a Tuesday at, 10 a.m., right? Like it was just way more of a style of getting to know the founders, really hanging out with the founders, not worrying so much about spreadsheets, kind of style.
And how would you internally communicate your excitement for a deal? Would a bunch of folks kind of meet the founder and then come back? Or
Yeah.
because in absence of an investment member or partner meeting, how do you socialize?
Yeah, I mean, part of the trick of getting an investment done at Founders Fund at the time was like, if you can like convince other people to go and meet with the founder, right, which was a requirement. So part of your job or part of any of our jobs was convincing your other partners to kind of even go meet with the team. If you couldn't even do that, then it wasn't going to happen. And if you could, then maybe it'll happen and they would do it on their own terms as well. Maybe they would go get dinner with the founder. It's still way more my style. I can't deal with board meetings. I'd way more just do strategy dinners and, tough in COVID, but at some point we'll be post-COVID. But yeah, that's still way more my style.
How did you like talk about your companies, like your excitement to convince your partners to come and hang out, come and take a look, because they're probably looking at a bunch of other things, right? In the beginning, how were you able to sort of?
It had to be like unique. Think like SpaceX versus like we were never. I think we're better now because our team is very, very, very different. Like now we have skill sets to be able to like really analyze spreadsheets and enterprise SaaS, but like no enterprise SaaS deal would have ever gotten done in those early days of Founders Fund. It would have just been felt like, this is just boring, right? Like, let's just get something exciting, right? Like, and in those early days, we had a lot of stuff that nobody else would touch. I mean, even when we did the SpaceX investment, we had, Founders Fund 2 was our first institutional fund. Mm-hmm. And when we did the SpaceX investment, we had people who had passed on the fund writing to us being like, oh, this is why we passed on you guys. This deal sucks. This is way too risky. How can you throw 10% of your fund into this, right? Like, yeah, we framed that message. SpaceX is $50 to $100 billion company now, right? Like,
that's right. How did what were those what were those conversations with LPs like? It must have been not straightforward because LPs expect a VC in a box, and this is very different from what their expectations is. How were you like the fund two first institutional fund? What was that process like in the fund?
I wasn't part of the fund's two institutional raise. Fund two institutional raise was end of 2007, and I came on board early 2008. So I didn't go through the fundraise for fund two. I mean, we now have, I don't know, 3, 4, 5, 6, 7 in growth, right? Like after that, but for fund two, I didn't go through that part, but I got to know all of these LPs and they were taking a chance. We had venture firms trying to kill our fundraise back in those days. You had very, very, very famous venture capitalists trying to say, oh, anybody who invests in Founders Fund will not be allowed to invest in this other fund. But it was, like I said, it was a personality thing. Like some LPs were going to be drawn to us. Like we didn't, and this is one of the key things that I'll talk about with you guys, but we did not look like everybody else. We did not look like anybody else. And so that's critical. I mean, like you standing out in a crowd is just critical. So there were some set of LPs, many of which have made a lot of money with us and are still with us forevermore, right? Like that there's some set of LPs who are like, yeah, at least this is different. I want to take a chance on this.
Right. And that's clear. Like something that is different, something that is obviously apart from everything else, just stand out. Early on, it is harder to sell that message, I guess, because you're looking for a specific type of LP. So it's probably easier to rule people out quickly because they won't do it. What was that process like with Fund 3 when you got involved?
Yeah, I mean, there were a lot of people. Stuff was still not proven, but again, like this is why you have to have something in your background that is forget me, right? Like I joined up with a team that was like Peter Thiel, Sean Parker, et cetera, right? Like these are guys who had a very, very, very unique background that people who are willing to invest in. You need something. If you're going, especially right now when there was a period where I got pitched by more new funds than companies, and which is ridiculous. Like, you need something that's going to make you really stand out. And those guys at that time had things in their past that made them stand out, right? Like founder, Napster, and, Facebook, and first investor in Facebook, and founder of PayPal, right? Like, that stands out. Right. And now we can do it because of the track record. I mean, what you really want to do is, as quickly as you can, build up a track record, because no matter what else in the LP world, it doesn't matter. Track record is everything. All they care about is returns. Period.
That's right. And then sort of going back on that, to build up a track record, you got to be in some great companies. And you've been pretty vocal about, the job of a VC. It's sourcing, picking, and winning more important than portfolio support, recruiting, things like that. And it sounds like you've given quite a bit of thought. I'd love for you to just share your perspective with the group on how do you, to build a track record, what is the most important things that a VC should be doing?
Investing in the best companies. I mean, like, you got to do this if you're just like coming out of a company and like, oh, I want to raise a fund and invest, like, you better have a proprietary network, right? Like, because otherwise, how are you going to win deals? Like, venture capital do you see the right deals? Can you pick the right deals? Can you get into the right deals, right? Like, and so it's like, if you've got a proprietary network that nobody else has, that of companies that nobody else exists and therefore can get into them because nobody else knows about it, great, that works. But there got to be something, because you're not going to like win a deal versus us. You're not going to win a deal versus benchmark unless you've got a proprietary network. So like, commodity flow won't work. And like, you just got to have your own unique stuff, or join a firm and be part of a team that invests in something awesome, then break out of that. But like, if you're kind of just doing this new on your own, there needs to be something that makes you stand out.
Makes sense. You can you talk a little bit about the allocation of so you mentioned you'd rather be part of strategy dinners as opposed to sort of board meetings. So talk a little bit more about that, about where, but why that is. Normally people think board meetings, that's where things get done. That's the job of a VC. But you have a different point of view.
Yeah, I mean, board meetings are sometimes that, but like, there's often, especially for the bigger companies, board dinners the night before. And that's way more exciting because that's when strategy is going to be discussed. Whereas board meetings, you get like updates, and it's a lot of financial analysis. And I don't do well looking at spreadsheets, right? I've never used Excel in my life. I've never looked at a spreadsheet in my life, right? Like, the only time I had to like do a spreadsheet, my wife had to do it for me, right? Like, I'm not a spreadsheet person, and board meetings have a lot of that kind of element, and I just want to focus on the strategy. So, right.
In today, more so than about 10 years ago, there are hundreds of new funds that come out every single year, right? And you mentioned, like, you got pitched by more funds than founders. Standing out is getting harder and harder. It's hard. So when you see these funds who pitch you, for the ones that do stand out for you, what are the reasons that they stand out? What do you find? What do you separate the successful ones versus the one not so successful?
I don't know. Like, for instance, like Sam Hinkie, he was the guy that did the process for the Philadelphia 76ers, right? He just raised the fund. He stands out. First-time manager, no investment experience, but he stood out because of his experience. So you can have a diverse set of experience, right? There's no right answer to this. There's no one right way to do venture capital, and there's no one right way to get in. You have to have something. It can be anything, right? Like something. It's just got to be something unique, right? And so whatever that is, really lean into that. What I always tell people, regardless of what they're doing, I'm terrible guidance counselor, but what I can say is find the thing that you are better at than everybody else and exploit that. I mean, this is strategy game 101, and I'm just a gamer, right? Like, find that thing that you can do better than anybody else and exploit that, right? My strategy, like, nobody's going to touch me at my strategy. They can win on their own strategy that I can't play. And like, some people are going to be great at numerical analysis, and I'm terrible at that, but you're not going to beat me at my strategy. So find your own and win at that.
The other challenge, sometimes the hard part about fundraising is the fundraising itself. It's just the process of raising, finding family offices, institutional investors. They have options. It's just a grind. It's much harder than for
especially now.
Yeah, exactly. So what do you say to folks who have something special, but it's not quite clicking. It's not quite moving.
Find an anchor. There needs to be some anchor. You need to find some anchor who knows you, who knows what your specialty is, and is willing to be the first to back that. Like, just pitching, what I always tell people is like, it's one thing to raise money from people that you know. My first fund, I mean, I raised it for people that I knew, right? Like, I raised it from a bunch of Google engineers and ex-Google engineers. They knew me, right? It wasn't like I was going and pitching random institutions, right? Like, so either raise money from people who know you and know how good you are, but if you're trying to convince like professional LPs who don't know you, you need to have some experience that very clearly stands out, and you need to have another anchor, because many of them don't like being first.
Right. Everybody wants to be on a moving train. A lot of the folks that are going through the fundraising process kind of start with a fundraising target, 10, 20, 30, 40, and it's but then other folks who have a different approach is, I'll just raise whatever I can. I'll just start investing, and then I'll think about larger and larger funds. What do you think?
No one right way to do venture capital, but here's what I always say. Your number one goal as a new fund manager is to prove a track record, period, right? It shouldn't be to raise a bunch of capital. In fact, it may be a lot easier to prove a new track record on a smaller amount of capital. If you like raise a fund that's $10 million and you invest in, 5 companies even out of that, and it works really well, then you can write your ticket for fund 2, fund 3, because now you have a track record and now you can pitch professional LPs, right? Whereas raising ad hoc and investing, that's great too. Whatever you can do, your first fund should not be about starting an institution. How about that? I'll put it like that. Your first fund should just be about getting returns as quickly as you can. Well, maybe not as quickly, but proving that you can generate returns. And I think that's a lot easier to do on a smaller fund. My first fund was only a couple million, right? I see people, we want to raise 30 million and invest in that a couple $100K at a time. That's never going to work. You just either raise a smaller fund and crush it, right? And then raise a bigger fund later, because you don't make your money on your first fund in venture. You make it by proving a track record and then having people buy onto the, as you put it, moving train.
I think this is a common misconception. I think a lot of folks begin to sort of look for branding by association, like who else invested after me, before me, around me, etc. What you're saying is the LPs understand which companies are doing well or not, irrespective of who invested, and that is generally well understood across the LP community.
That's correct. If you're talking about professional LPs, they know what's good, they know what's tracking, because they're in so many funds, right? And they see this and they pay attention. Again, the good LPs are not stupid, right? They're very smart, and so they know what's tracking. Now, do they want to be first in something? No, but do they know what's tracking? And if you're in that and it's tracking, will they give you more money? Yeah. Again, they're all about returns. Period.
Right. That's right. You've seen quite a few cycles now, right? You've seen the early stage sort of folks institutionalizing seed, scout programs, now rolling funds. Where do you think this is all going? More capital than ever in venture. What's your take?
I don't know. I never focus on it. I just focus on the same thing I focused on ever since I started doing this 15 years ago, which is find really good founders and invest in them.
And what's your sourcing? It's like getting in front of the best founders. That's
sourcing is critical. This is why you always hire people or put people around you to maintain fresh networks. And again, if you're starting out in venture capital, if you're the sourcing thing is no joke, right? If your main advantage is that you've got proprietary networks, that's huge. Sourcing, picking, getting in, those 3 parts are equally as important. Helping the company afterwards, to me, is way, way, way less important. But those first 3 parts are equally as important. Nothing wrong with being a great sourcer.
You mentioned that you like to grab drinks with founders, getting to know them. That's the founders fund way of getting to deeply understand the founders' motivations, etc. In a COVID world, that must be hard to do. It's got to be a lot of Zoom, and it's not, you don't get those sort of signals anymore. How have you sort of adjusted, or what signals you picked up now?
Yeah, I agree. It's actually made it so that I haven't done a lot of new investments in founders that I don't already know. Fortunately, look, we've got, we're currently investing at a $1.5 billion fund and a $1.8 billion fund. And a lot of that is going to be large follow-ons in companies that we know. It's I don't need to take a drink with him to know that I want to put more in Max Levchin and put more into Affirm, right? Like that's easy. And then so most of our checks are about the getting in. Most of our stuff right now is about the getting in on stuff that we know is really good. Like, can you get more into Stripe? Can you get more into Affirm? Can you get, et cetera, et cetera, et cetera, right? Versus, I think there is challenges. I've only done one new large check investment since COVID hit. And I did go on an outdoor walking, meeting with that founder. And it was still a struggle because you're right. A lot of my stuff is getting to the founder. So I think this part of the strategy is very hard right now. The part about plowing more money into your winners, that part's pretty easy right now.
Got it. And a lot of the new deals, a lot of the new things that are not obvious yet come very, very early at the angel, pre-seed, seed, etc. How does Founders Fund work with sort of either founders or angels who are surfacing those types of deals or those types of networks?
I mean, we'll take, again, we take any introduction very seriously, and you have your graph. And when we have tons of like seed investors who we work with who send us stuff, we never cut them out of anything. Like if somebody sends us a deal, like, because we don't have any sort of requirements on ownership percentage or dollars in, like we have none of those requirements. And so if some seed investor sends us one of their best things and we want to do it, seed investor can take, let's say the company's raising 10 million, seed investor wants to put in 1 or 2, great, fine, put in 1 or 2, and we'll take the rest. We have no rules on ownership percentage requirements. And so we can kind of work with everybody and not cut them out of what they want. So there's literally no reason for them not to send us anything.
I heard a slight sort of thread that I want to pull on another sort of a rule or rules that maybe Founder Fund wants to break, which is ownership target, check size. Funds live by them. Can you just explain that part a little bit? How does the math work for you relative to what is commonly perceived to be you got to get as much ownership as you possibly can? If you don't see it,
you'll abandon a complicated formula, and I'll have to show you in Excel. No, I'm kidding. Put the most money into the best companies possible at the best price possible. That's how you get returns. Like, I'm sorry, like there's nowhere in that is ownership percentage or blah, blah, blah. Put the most money in to the best companies possible at the best price possible. That's venture capital.
Right. And I guess the question underneath that is that your ability to figure that out for the right company, that's the magic, right? Like just knowing which company to do that in at what time.
All three. See the right deals, pick the right deals, get in. So all three. Like again, we could all be able to pick, oh, Stripe is a great company. Okay, but can you get in? Like it's just as important, right? Like, I mean, seeing, picking, getting in. These are all equally as important.
Have there been cases where you felt that way about the founder, there's something special, but then as you thought more about it, you kind of convinced yourself maybe this is not a great company or a market or a product. Yeah. Founder is great, but there are these other issues.
Great question. I think that's the part that Founders Fund has actually gotten better at in recent times. It's like it used to just be all about the founder, right? We didn't have none of our team could do financial analysis back in the early days. Nobody. These people who were part of Founders Fund, like this was not a financial analysis shop. Now we supplement like, the founder stuff, the like willing to look at anything stuff with people who are also really good at doing these other pieces. And so that's what I'm saying. It's like absolutely, we've had times where founder gut was there, but the rest of the company was off. Now we've screwed up on that, several times. Like back in the early days, like financials didn't look good on Peloton, even though like I'm like, this is going to be an epic brand. We didn't do Peloton. But like in general, we've gotten much better since we add people with different superpowers. Here's the secret of venture capital. There's just not that many great companies. And like the best people can spot the best companies if they see them. And so like, again, it's just, there's not enough room for 1,000 managers
right.
to make a lot of money in venture. There's just not enough good companies. So you really have to have your edge, right? Whatever that is.
So without revealing your secrets, if you were to
I'm happy to reveal my secrets because I don't think anybody can copy them.
Let's talk about that. If let's say like when it comes to winning an allocation in a tough deal, maybe pick an example, Stripe, I don't know, any example you like. What are the tricks of the trade there? What do you do? What do you employ to get into one of those great companies that is competitive?
I employ no tricks. There's two things that you need for that. You need a brand. Founders want to have a good brand. This is why random firm X is probably not going to beat us in terms of the getting in, because our brand is what it is. And it's tough. Founders want that. Number two, it's the relationship. If the founder has a choice, it's the founder's personal relationship with the individuals, right? Plain and simple, right? If you're the kind of person that the founder likes talking to and likes going, whatever, you're going to win that deal. And so I don't employ any tricks. I just try and be myself. And I know that some companies it's not going to work with, and some companies are not going to want the founder some brand, right? And so that's, fortunately, I think we've built a brand that top founders do want. Maybe some lesser founders might not, but top founders want the brand because founders also want to go where there's returns, just like LPs. And so it's oh, you guys are the fund that backed Facebook and SpaceX and Stripe and Airbnb, whatever, right? Okay. And so between that and the personal relationships, there's no tricks. It's just being myself.
Got it.
And being associated with the top tier brand. Again, that's critical.
Brand. It's what today, if you're trying to build a brand, you kind of it's on social, it's on Twitter, it's on it's blogging, podcasting, etc. But that's sort of mass media brand building. Whereas there are other folks also who have a brand, but with a niche audience, maybe just engineers leaving Google or things like that. It's but what you're saying is it doesn't have to be a mass media brand. It just has to be a brand that your target respects.
You got it. That's right. There's not one right way to do this, right? Have an edge. Maybe your edge is you're the world's greatest engineer. And so all these really hardcore tech people just love you. Nobody else knows who you are, but all these people know who you are. And in fact, they're going off and starting ridiculously good companies. And they're of course going to talk to you because you are who you are. You're famous in that small circle. That's huge. That's a huge advantage. That's an advantage that I probably don't have. Great. Exploit that, right? Strategy games come down to take your advantages, take your moats and exploit them, right? Don't willy-nilly around with things that you're not very good at or whatever. Just take your advantage and exploit them. If that's your advantage, what you were just describing, I think that's great.
That's right. And part of it is, I think a lot of folks operate with FOMO. They see other people doing something and it's natural instinct is to copy because the expectation is that is the path to success because we don't know what the other path to success is. What advice do you give folks to sort of prevent against those types of mental pressures, just to copy others, just to see what everyone else is doing instead of focusing more inward?
I just don't need to work. I have one of my advantages, and I don't think you can clone this, is I have no FOMO. I just don't care. It's if we miss something, so I'll tell you this story. I graduated Stanford in 99 from the CS department, and in 99, all good CS people had offers from Google. Some took it, some passed. I didn't know Larry, I knew Sergey. Sergey was kind of this goofy guy. I passed on the Google offer in 99. Though in 03, a lot of people who did pass on said Google offer, right? We're oh, it's too late to join. It sucks now. It's too late. It's over. It's already worth, almost $1 billion. We can't join or whatever. I'm screw that. Right. And joined. It wasn't a pride thing. It was no, this is still really good. And so I joined Google back up in, late 03, early 04. Great. So it's the same in investing. Right? It's fine. We missed the first couple of rounds of Airbnb. No problem. Once we saw how big it was, we went all in. Right? So I have no FOMO because I can always come back in, and I have no fear of writing big checks. And a lot of people do. I talk to so many managers who are oh, well, we wouldn't really put more than 3% of our fund into one particular investment. I'm that's not going to work. Right. So
process things that, I guess what I'm trying to unpack is when you say you have no FOMO, how do you, when you see something that might trigger FOMO in other people, but it doesn't trigger in you, what is that? What happens? How do you process that thought?
I just don't care about what other people are doing. If I see a company, regardless of what stage it is, and regardless of I've passed before, right? If I see a company that's doing great, I'm going to go try, or that I think is unique, that has moats, it's tough to get an investment from us, but that has real moats, that has a great founding team. I'm going to go try and get that deal. Again, it's not a matter of, oh man, I wish I would have, I never said like, oh, I wish I would have done that or whatever. It's just like, no, just do it later.
Right, right. We've seen other investors who have passed on companies go on Twitter and essentially say that why that company will never work out, and they kind of dig a deeper and deeper hole into it, which is probably a waste of time, because it's like
the LP that sent us the letter of why they passed on us, because we're
right.
not because they were happy that they passed on us because we invested in SpaceX.
Yeah, because there is a sense that VCs just want to be proven right. They want to be seen as making all the right calls, even when they say
Don't
no.
care. Don't care. I just care about returns. I can literally stay out of the Twitter stuff. I stay out of the, I mean, again, there's no one right answer, but I don't care about any of that. I only care about returns.
You mentioned something about commodity flow. I think what you meant by that is deals that everyone else is seeing.
Correct.
If you have access to that kind of deal, then you have no edge. Like, would you put YC under that bucket too? Deals that are coming out?
YC is pure commodity. I mean, like YC is pure commodity. In 2006, 2007, it wasn't commodity. Like I said, there were like 10 people in that room. Like now, of course, it's commodity. I mean, like you need your own networks, right? Stuff that everybody sees. You are not going to win deals of stuff that everybody sees. Right. As a new manager, like again, founders want brand, unless you have a personal relationship with said founder. Again, this comes back to sourcing, right? Like if you've got a network where like you're going to be able to win this even over Founders Fund or Sequoia or Benchmark. Oh, okay, great, because the founder has a personal relationship with you. That makes sense. That happens. But like if they don't know you, you're not going to win the deal.
Right. And networks usually come out of professional experiences or educational experiences, right? It's like I guess what I'm trying to understand is like, what would you consider a new network? If someone comes out of Stripe and they have access to folks out of Stripe, other people might also have access to it, but that's okay, but you do have something different, I guess.
This is historic for us, right? Like the PayPal Mafia, our first couple of funds were investing in PayPal Mafia. I mean, that doesn't work anymore, right? Like you have to have fresh networks. And then we had Facebook Mafia, kind of deal flow. And then we had like SpaceX stuff, right? Like it keeps flowing, and Stripe Mafia is somewhat interesting, but yeah, there's a lot of them. And so it's tough to distinguish. I mean, Lockheed's obviously doing pretty well. Like there's a bunch of these people, but like, yeah, proprietary network deal flows either from education, work, where you're from. Maybe you're from another country, right? Like, that people, like maybe you're from a small school that like UIUC back in like 94, 93, 94 with like Andreessen and Lev Chin and Luke and like Bannister and all these guys, right? That's a crazy come out of nowhere kind of thing, right? You may have that. I mean, there's no rules on this.
That's right. So now that you have these amazing poor companies like Affirm, SpaceX, and others, do you actively try to sort of harvest the networks or build mafias in those companies?
Yeah, sure. We always talk to anybody who's coming out of one of our top companies, always.
As in more proactive, would you do something, embed yourself?
Some people, I'm not a proactive VC. Like there's no one right way to do this, right? Like some people are proactive, some people are reactive. I'm as pure 100% reactive as you can be. There's other guys who I think like Sean Parker was probably the greatest proactive VC I ever met, right? Like he would have like an idea on how the world works and be like, oh, let's do that. Like, oh, right. Facebook is going to be big. Facebook or Spotify. This is clearly how the world works. Spotify. I'm not like that. I'm just like pure reactive.
Right. And then when you say reactive, you mean you get inbound, I'm guessing, or you get referrals. And so
yeah, it's referral. At this point, it's just all referrals, either from my own team or from people that I know in the seed network or whatever.
So walk us through the life of a successful deal for you, something that comes in that, yesterday, like today it might come in, you haven't seen before. How would you, how would you prosecute that deal?
Do I think the founder is awesome?
So email comes in, you probably would look at a description or someone said
who it came. No, I really don't look at a description of the company, but I look at who it came from. You try and route to the best member of my team, who would be like, who wants to look, because I know what the preferences of all the members of my team are. And so kind of route to them and, whatever. Or if it's something that I'm really, the right person to look at, then I'll take a look and talk with the founder.
Got it. How do you think about sort of exits? How do you think about cashing out? Because it goes back to the other side of the returns question. How do you think about when is the right time to get some returns?
Well, I never think about it. Because for a fund of our size, either something is going to be one of the biggest companies on the planet, in which case that doesn't mean like getting bought by random company X, right? Or it's not going to matter to the fund of this size. So just either it's a ridiculously valuable company, in which case I just don't bother to think about exit.
You just ride it. Like,
I also do like you have to be really, 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 really comfortable with long time frames. To all the managers, like we've had some of the most epic funds in history. I started Founders Fund in 2008. I started at Founders Fund in 2008. It was probably like 11 years later before getting a carry check. Like this takes, and these are for like the Founders Fund 2 is going to be a better fund than like Benchmark 7 or the Benchmark fund with Uber, right? Like these are like top funds. Like it takes a long time.
right,
So you have to
right.
be really comfortable with that.
Well, that raises the obvious question. Like, how do you get LPs comfortable with it, or is that the reason they invested in the first place?
LP, all institutional LPs know that.
And they're comfortable knowing that they also don't want to cash out. They want to ride.
They're in this long game. Again, they're doing IR. They're doing IRR calculations, right? And so it's like as long as you maximize IRR, it's time. How long it takes is not relevant for them.
Right. Makes sense. And as you think about sort of you guys now have a seed strategy, I believe. So folks who invest in seeds, are you able to?
Our minimum check is 100,000. Our maximum check is probably 500 million.
Minimum check 100,000, maximum check 500. Wow, that's amazing. That gives you a lot of latitude to look at all types of deals, right?
Yeah, we look at there's no rule. We're completely stage agnostic, sector agnostic, geography agnostic. Yeah,
makes sense. And when a founder is reaching out to you, it sounds like cold is probably not going to work as well. It's got to be through a referral guy. It's got to be through someone who knows.
I've never answered cold email in my life. It's just too hard. I mean, I would like to, but it's too hard. So I think one of the skills that the best founders have is like networking with other people and getting intros that way.
Makes sense. And then it's scout programs became quite a thing several years ago, where you would seed a bunch of folks, seed deals, and then so that you could do those deals. And when it came to Series A and Series Bs, nowadays folks that don't have to do scouts as much, you can just invest in their funds as GPs. Is that something you actively do? Do you invest in funds personally, or Founders Fund invest in other emerging managers?
Sometimes, we're not a fund to funds, and so we don't do a ton of that stuff. A lot of the GPs at Founders Fund, myself included, are investors in some funds. I've had to stop that recently because it was like too many. But yeah, I mean, we either Founders Fund, but rarely Founders Fund anymore. But a lot of times the GPs invest in other funds. Like Peter's an investor in like 50 funds. Like I'm an investor in 20 funds, right? Like Keith is an investor in a bunch of funds, right? I mean, but we also have just really good relationships with, even if we're not investors in a fund, we have good relationships with, again, a lot of your seeing the right deal flow is being close with the seed network, right? And being close with seed investors.
Right. But it sounds like that, it got out of hand, like way too many funds that you guys were investing in, or
it got out of hand. Way too many funds that we were seeing, way too many funds that we were investing in. Just it got out of hand. Like it got out of hand. Yeah.
Got it. And is that if you were like just case that if you were to do this on your own, if you were to be in this position of the folks who are just starting off now, just what would you do? Would you start at this super early stage angel seed like you did back in 2004, or would you do something? I
would do the thing where I've got an advantage that nobody else has, even if that's a small one right now. Like maybe I know nuclear physics better than anybody else. Fine, invest in some nuclear physics company. I don't know. Like I would find something that not everybody else was doing. Like I can't stress enough to new managers. There are so many of you, and like there's got to be something to do to stand out.
That's right. I mean, that is just crossing that threshold. Just being able to stand out in and of itself is a success metric nowadays, right? It's like hundreds and hundreds of funds.
Yep.
Has the landscape changed at the Series A and the Series B stage? Are there still just as far more competition at that stage now than when you guys first started, or is it still?
There's a lot more of everything now than when we first started. But yeah, I mean, but it's like people are getting better at this. Like, people can spot the best companies earlier, and so they get bid up, right? And so then pricing becomes an issue. So you always have to think through, like, well, what is contrarian, right? Like, we invested in Anduril, which is this shirt, because like a lot of people in Silicon Valley don't touch defense companies because it's not it makes them look bad on Twitter. We don't
Right.
care. We're not going for popularity or Twitter popularity or popularity with Silicon Valley insiders or with whatever. Like, we're just going for returns. Our lowest fund is like 28% IRR. It's like ridiculous, right? Like, this is everything. Like you're either if you have returns, nothing else matters. So, and if you stop generating returns, your powerful brand won't matter. Like, it's all about returns.
That's right. That's right. Brian, this has been terrific. Any parting advice for the group of folks? That it's like it's very clear. Like, double down on your own strategy, get returns, get into great companies. It's simple.
Don't let anybody tell you how the right way to do this is. There's no right way to do this. Like, figure out what you're really good at and figure out a way to exploit that. I don't mind telling people like my secret, because I don't think people can clone me, but it's not going to be the thing that works for everybody. And I don't believe that my strategy is the only one that works. Right. There's lots of strats that could work. Just make it unique and figure out what works for you. It's hard to get to that, but I can't stress that enough. It's like, that is the way to win.
That, and I guess what you're saying is that is, if the emerging founders, emerging managers spend a lot of time, that is the one thing to think really deeply about it. How do you stand out? What is your edge? What is your strategy? And just double down on that. And what you're saying is ignore all the noise, ignore FOMO, ignore Twitter, ignore pushback, ignore rules. Just double down on that, because if you're right, then you're really, really right.
You got it. And that's the only, by the way, that is the only way to win in this. It's like, you have to, like, the SpaceX investment that we did was crazy. It was like over 10% of our first institutional fund. Like, most people like would never touch that. And a crazy rocket ship company that had never at that time gotten a successful rocket up. Like, they had never gotten a successful rocket up, right? We took the bet, it paid off, it pays off big. Right. And that's what I'm looking for.
I gotta ask though, was there any nervousness post-investment or around about the investment that you are doing something that hadn't been done before? Is there a feeling of
Elon is ridiculously good.
That's it. Like, back the best. This is a great parting advice. Brian, this has been a breath of fresh air. Thank you so much for sharing.
No problem.
No holds barred. I think founders have greatly benefited. We have 129 people or so just joined this group. So thank you again to Brian. Thank you again to everyone who joined. We'll see you in a few hours with Anne. Have a wonderful rest of the week.
Thanks, guys.
Bye.